Hey, happy Monday. Quick market update. The question on everyone's mind seems to be hey, Jason, if inflation's coming down, why are mortgage rates still going up? And that's a fair question. Last week, Monday to Monday, we're up about a quarter of a point across the majority of products. And obviously, that's the opposite of the direction we were planning on being here right now. So let's talk about the why. Couple different reasons that are seeing us where we are right now. First and foremost, it's not the primary driver, but the debt ceiling situation is certainly not helping things and is definitely exacerbating some of the other factors at play here. That's one. The good news is it's temporary. Hopefully, we've seen this come up in the past. A lot of times, it's just an opportunity for political grandstanding and just both sides of the aisle play games of chicken with each other. But again, this will pass. So hopefully, once it's out of the picture, it can stop manipulating what things are going on. Secondly, we have commentary out of the Fed. We've been talking over and over again. You've heard me talk about the Fed driving a car, but looking in the rear window because they're driving the car based on old data that lags, and they were late to react to inflation by calling it transitory, and they were dead wrong. And now they're really just trying to save face and credibility. At the end of the day, they're still commenting in a way that we almost might see another rate hike in June on the 14th. After some of the recent comments, we were at almost as near zero chance they were going to hike rates again. And now we're seeing that has gone to about 40% is the likelihood that they're going to hike rates another 25 basis points again, which is just nuts. And hopefully it doesn't play out that way. One saving grace is there is a CPI report on the 13th, the day before the next plan announcement. Maybe that report comes in good and keeps us out of another hike, but we're gonna have to wait and see. But again, commentary out of the Fed, what they've been saying, and how they're still not seeing the picture. It does have markets reacting in a bad way as far as bonds go, which trickles down to mortgage rates, as you know. Last, but basically the primary driver of why rates are jumping up has to do with what's going on in the banking sector. We saw what happened with Silicon Valley Bank and what happened with Signature and how the FDIC and the Fed stepped in and reacted. And what this resulted in was a few things. One, you are seeing people take deposits out of banks in mass. Banks are losing revenue, banks are losing deposits like crazy. And a big part of the why here is that they can take consumers can take those monies and put them in a money market fund at a much better rate of return than just sitting in a savings account for next to nothing and having to take on the risk of the current banking sector for no real reason. So that's a big driver right now. So when you see deposits fly out of a bank, banks need to raise capital, need to raise it fast. Now, they can't generate revenue by stock shares or selling stock because their stock prices are all getting the crap beat out of them. So they've got to sell assets, and there's not a lot of assets they can sell. So what are they selling? They're selling treasuries and they're selling mortgage-backed securities. So supply and demand starts to kick in, and as you see those sell-offs, you're seeing bond prices react in a way that, again, is driving up mortgage rates. That is really the prime driver here. The positive on that, just like the debt ceiling piece, it can't be ongoing in perpetuity. There's a finite supply of assets on these banks' balance sheet, and they can't sell them forever. And you're not seeing a consistent sell-off. What you're seeing is just big chunks of selling. We had one right around that April 16th date when we saw the FDIC step in, and you're seeing another one just recently here in May where there's another big sell-off. So hopefully that impact has been absorbed by the market and we'll start to kind of move from there. But those are the three things that are really driving rates up right now. Hopefully we get some turnaround and there's some good news on the horizon. In terms of any relief this week, we don't have a ton of data coming out. Friday, we do have the PCE, the Personal Consumption Expenditures Index. That is the Fed's favorite measure of inflation, but unfortunately, on a year-over-year level, our expectations are we're going to be pretty much flat. So we don't see, it's not time to put the champagne on ice just yet. Hopefully, it doesn't go the other way, and I'll settle for no news as far as bad news. And that's about it. Real estate wise, we've got some other figures coming out this week in terms of we've got pending home sales and new home sales, but that's about it. There's not a ton going on this week. So again, we're stuck in a position where the technicals are going to drive the market absent any news. Unfortunately, all the news is really going to be focused around debt ceiling and a few of the other things that are not putting rates where we want them. So for everybody out there who's hoping rates to get better, hang in there. We will get there. Inflation is coming down. Things will get better. It's just taking longer than we all expected. That's about it for this week's update. Hope you have a great week. Take care.